For decades, Germany has been Europe's economic powerhouse, the manufacturing giant that produced 1 in 10 of the world's goods, the backbone that held the entire European Union together. But today, that foundation is cracking. Germany's economy is shrinking for the second year in a row. Volkswagen, a company that hasn't closed a German factory in 87 years, is now considering the unthinkable. Over 3 million Germans are unemployed, and the country that built its reputation on never spending more than it earns has just announced a €500 billion spending package. This isn't just about Germany anymore. This is about whether Europe itself can survive what's coming next. The German miracle explained. To understand how Germany became one of the world's most successful economies, we need to explore what made Germany different from other developed nations. While many countries transitioned from manufacturing to a service-based economy, focusing on finance, technology, consulting, and other intangible sectors, Germany took a different path. They made a conscious choice to double down on producing tangible goods, on making actual things. This decision was rooted in Germany's unique history and industrial culture. After World War II, Germany was devastated, but its leaders and entrepreneurs recognized that rebuilding the economy would require a focus on craftsmanship, engineering, and manufacturing excellence. The result was a robust industrial base that continues to serve as the backbone of the country's economic strength today. Take, for example, Wolfsburg in northern Germany. It's not just a city, it's a symbol of this industrial strength. As the home of Volkswagen's massive car factory, Wolfsburg hosts the largest automobile manufacturing plant in the world. This single factory employs around 60,000 workers, producing nearly 1 million vehicles every year. To put that in perspective, this one factory produces more cars annually than the entire United Kingdom or Italy combined. This factory is a marvel of industrial efficiency and scale. It embodies Germany's focus on quality manufacturing, delivering durable, well-engineered products that are highly competitive on the global stage. This export-driven model is not just about making cars, it's about building a network of industries, from machinery and chemicals to electronics, that are all focused on export markets around the world. And this export-oriented approach led to something remarkable. Germany consistently maintained massive trade surpluses. Essentially, they were bringing in more money from their exports than they were spending on imports. Over decades, this model created a steady flow of income into the country, which funded further investment and innovation. In fact, Germany has averaged about 7% of its GDP in trade surpluses, which is extraordinary. To give you context, most Western economies tend to run trade deficits, meaning they import more than they export in order to fuel consumption and growth. Germany, on the other hand, was producing more than it needed, selling these goods across the world. Now, you might wonder, how does a country sustain such a model? One key factor is that German companies and policymakers prioritized long-term stability over short-term gains. This brings us to a crucial decision made in 2009, during the aftermath of the global financial crisis. In 2009, Germany passed the debt brake, or Schuldenbremse in German, a constitutional amendment designed to limit government borrowing. The rule was simple but strict. German federal and state governments could only borrow up to 0.35% of GDP annually for new investments. This was a deliberate move to prevent reckless borrowing and to enforce fiscal discipline. Compare this to other major economies, such as the United States, which regularly borrows over 5% of GDP each year to fund deficits and stimulus measures. Germany's approach aimed to stabilize the economy by preventing excessive debt accumulation, which can lead to long-term vulnerabilities. This fiscal discipline allowed Germany to maintain a relatively low public debt ratio, around 60% of GDP, compared to many other countries that are significantly higher. it also meant more reinvestment in infrastructure, education, and innovation, factors crucial for sustained economic growth. And it worked. From 2010 to 2019, Germany experienced impressive economic growth, a 25% increase in GDP over those 9 years. Unemployment rates fell below 5%, reaching historic lows, and the country's factories and industries thrived. Germany's trade surpluses during this period averaged over $200 billion annually. That's more than any other nation on Earth. These surpluses funded investments, paid for imports of raw materials, and contributed to the country's overall prosperity. But of course, no success story is without debate. Some critics argue that Germany's surplus-driven model can create imbalances globally, particularly with deficit countries in Europe or the United States, which depend on borrowing and consumption. Others worry that such a focus on manufacturing could make the economy less adaptable to rapid technological changes in the service sector. However, Germany continues to adapt by investing heavily in advanced manufacturing, digital infrastructure, and research and development. The country aims to stay ahead in high-tech industries like renewable energy, automation, and AI. So, what lessons can we draw from Germany's approach? First, that a focus on manufacturing, quality, and exports can build a resilient economy. Second, that fiscal discipline, such as strict debt limits, can provide stability and room for long-term planning. And third, that combining these strategies with investments in innovation can sustain growth in the face of global economy. The cracks appear. But here's what most people missed. Germany's problems didn't start with Ukraine. They started in 2019. The first crack appeared when China began moving up the value chain. Chinese companies weren't just cheap manufacturers anymore, they were direct competitors. In the car industry, Chinese brands started replacing German cars inside China itself. By early 2019, German industrial production fell by 4% year over year. The economy actually contracted in the second quarter. The export-oriented model was showing its fatal flaw. If other countries stopped buying German products, the entire system would collapse. Then came COVID. Global trade ground to a halt. For any country, this would be bad. For Germany, which depended on exports for nearly half its GDP, it was catastrophic. German exports fell by 10% within months. Car production dropped by 25%. The economy shrank by 5%, its worst performance since World War II. But the real disaster came with Russia's invasion of Ukraine. Overnight, 20 billion euros in Russian exports vanished. But worse, 55% of Germany's gas came from Russia. When that supply collapsed by 90%, electricity costs spiked 35% in just months. Suddenly, German factories weren't shutting down because of lack of demand. They were shutting down because they couldn't afford to keep the lights on. The impossible choice. By 2024, Germany had been in recession for 2 straight years, something almost unprecedented in the developed world. The GDP had shrunk by over $200 billion, enough to fund their entire healthcare system 6 times over. Normally, when rich countries face recession, they spend their way out. During COVID, America spent over $5 trillion. The logic is simple: pump money into the economy, build infrastructure, pay wages, and restart the economic machine. But Germany couldn't do that. The debt brake meant they were constitutionally forbidden from borrowing enough to make a difference. Even as unemployment soared past 3 million, the government's hands were tied. Then came the final blow. America threatened 15% tariffs on German goods, their third largest trading partner. Models showed this would knock another 20 billion euros off the economy. Meanwhile, Trump demanded Germany increase defense spending to 5% of GDP, an impossible target given their other crises. Germany faced an impossible choice: stick to their fiscal rules and watch their economy collapse, or break their most sacred principle and risk everything on an unprecedented gamble. The €500 billion gamble. In March 2025, Germany did the unthinkable. They ripped up the debt brake and announced a €500 billion spending package, 15% of their entire GDP, the largest spending spree in the country's history. €300 billion would go to infrastructure, high-speed rail networks between major cities, repairing the 36% of bridges in urgent need of repair, expanding broadband coverage from just 30% to EU standards, another €100 billion for the Climate and Transformation Fund, massive offshore wind farms in the North Sea generating enough electricity for 1.6 million households. Solar capacity increased fivefold by 2030. The theory makes sense. Models predict this could lift GDP growth back to positive territory within 2 years, creating over 1 million jobs. It worked for Japan after World War II. They spent a third of their budget on infrastructure and achieved 9% annual growth for 2 decades. But there's a problem. Germany isn't building from scratch like post-war Japan. They're improving existing infrastructure, which delivers much smaller gains. And these projects won't boost growth until at least 2027. Meanwhile, they'll pay €40 billion annually just to service this new debt, 8% of the federal budget. German bond yields have already climbed to 40-year highs. If interest rates rise just 2% more, it'll cost an extra €25 to €30 billion every year. The European domino effect. But here's why this gamble is so dangerous. It's not just about Germany. The entire European economy relies on Germany as the lender of last resort. When countries like Italy, Spain, or Greece face financial trouble, Germany steps in behind the scenes. Investors lend to these weaker economies not because they trust Rome or Athens, but because they assume Berlin will bail them out if things go wrong. That system only works if Germany itself is rock solid, but we're already seeing foreign investors trimming their German bond holdings. Credit agencies are warning of possible downgrades. If Germany's gamble fails, it won't just destroy the reputation they've spent decades building. It could trigger a cascade of crises across Europe. Countries that depend on German backing could find themselves unable to borrow. The entire European project could unravel. So here we are. Germany has bet everything on a complete transformation of their economic model. For decades, they were the guarantor of financial discipline in Europe. Now they're positioning themselves as the driver of massive state-led investment. If this works, it could reignite not just the German economy, but all of Europe. If it fails, we could be witnessing the beginning of the end for the European Union as we know it. The outcome won't just shape Germany's future, it will serve as a test case for the entire developed world. Can massive government spending still create economic miracles in advanced economies? Or is that era long gone? The next few years will give us our answer, and the stakes couldn't be higher.